Good morning everyone, this is Amit Pawari, founder and managing director of CR Forex. From last couple of weeks we have been discussing that the major trend in the rupee is on the appreciating side and the pair can move towards 81.50, and exactly on last Monday the pair went a low of 81.67, and probably looking at the market we can say that RBI must have intervened and bought dollars. Now the big question is where we are heading. Let us discuss that in today's presentation. Now what next? I think we have entered into a consolidation phase where we have positive sides also on the negative sides also. Let us start with the positive sides. On the positive side, FII and FDI continue to invest in Indian equity market and Indian market. Second positive is weaker DXY. As we have seen that DXY is struggling to cross 103 kind of a level, because of which all emerging market currencies are appreciating. On the negative side, if we observe that close to 81.70 and 81.60, either RBI is intervening and buying dollars, or natural demand from oil marketing companies or importer has been there. So it is indicating that 81.50 to 81.70 is acting as a strong support for the pair. Second, there is a fear in the market that Japanese central bank might increase the interest rate in coming days, because of which there can be a sell-off in all riskier asset, and hence all emerging market currencies can get weaker. Now let us discuss outlook for rupee. For the near term, we can say that rupee has entered again into a consolidation phase where 81.70 to 81.90 will act as a strong support for the pair, and 82.60 to 82.70 will act as a strong resistance for the pair. But in order to hedge effectively, we must know the bigger view of the pair, and the bigger view remains the same. The rupee is not going to get weaker beyond 82.70, 82.80 kind of a level, and eventually it is going to come down towards 81.50. So any uptick should be used by an exporter to increase their hedge ratio, and importers should not panic and hedge more. Ideally, they should only cover for short-term imports. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of the thin margin exporters are taking costing between 81.90 to 82 kind of a level, and the bigger view of rupee is that the pair is going to face tough resistance at higher level of 82.15, 82.70. So in that kind of scenario, all thin margin exporters should cover 80 to 100% of their exposure between 82.25 and 82.50. If someone is waiting, they can keep a stop loss of 82 and wait. If 82 is broken, they should ideally just simply go and cover. Some of the thin margin exporters have been asking us whether they can sell in anticipation of order. We can suggest them, if your monthly exposure is close to $20 lakh, then maximum you can sell 10% of your monthly exposure between 82.25 to 82.50 kind of a level, and ideally you should go and sell 1 year forward contract, because the premium percentage is higher at 1 year, and you will get a time to either cancel or utilize the forward contract. If anyone is entering into such kind of a trade, they should keep a strict stop loss of 83.05. Now let us discuss strategy for thick margin exporters. Many of the thick margin exporters got panic when rupee traded below 81.80, as they have not covered adequately. Now they should be happy that they have got another chance to cover as the pair has come up. Any levels between 82.25 to 82.60 should be used as an opportunity to increase their hedge ratio. On a confirmed order basis, they can hedge 80 to 85% of their exposure. If someone is hedging against anticipation of order, they can keep a hedge ratio between 50 to 55%. Now let us discuss strategy for importers. Importers should not cover aggressively, as the biasness is that the pair is going to face tough resistance at higher level of 82.50 and 82.70 kind of a level, and gradually the pair is going to move towards 81.90 and 81.50 kind of a level. In this kind of a scenario, ideally importers should cover only near-term imports. When I say near-term, it means 15 to 30 days import. To cover that, they should wait with a stop loss of 82.50, and they can buy close to 81.90 to 82 kind of a level. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.